Part 8. Control identifiers, profile strategies, and market profiling templating. The legend Paul Tudor Jones once said, "Don't be a hero. Don't have an ego. Always question yourself and your ability. Don't ever feel that you are very good. The second you do, you are dead." Welcome back, guys, and this is part 8, which is the final part of module 2. In part 8 we're going to spend a little bit of time again on those control variables. Just understand the key principles behind the control variables. We're then going to talk about 3 very distinct profiling patterns, which I'll break down for you again on the blackboard, show you where the bias is and where the potential for trade strategies are. We're then going to finally put together module 1 and 2 and put all the principles that we've dealt with into one volume profiling template, and that template you will use every single morning when you're prepping on the weekly basis. You'll constantly use that, and it'll help you to not just understand and summarize all the principles we've done so far in module 1 and 2. We'll then finish off talking briefly about deliberate practice as we're going to be utilizing a replay functionality quite a bit in module 3. So let's get straight into it and talk about those control identifiers. Now, firstly, what's important is, to make sense of this information from volume profiling, it's important to be involved in the process that forms the profile. Those who stay with it will soon begin to visualize the completed profile before the day is over, like visually building a puzzle. So what I'm trying to point out to you is that sometimes there may be a low volume area, or there may be a lot of two-way trade in the market, and we can identify this. It doesn't necessarily imply we have a trade opportunity or a viable trade strategy. But what it does do is, by watching it and constantly interpreting what we're seeing, it's aiding us to almost visually interpret what the day type may be like. Now, if over the course of the day suddenly the market does something against the objective or the facts in front of you, that might present the opportunity, and that is why we're constantly observing, questioning, and watching the day as it's playing out. As it plays out, we will slowly but surely learn to build the puzzle before it gets built and confirmed by the market. Now, it's important to ask ourselves a lot of the time, what do we expect to see? Okay, if you're constantly asking yourself, what do you expect? What is your expectation? You will start to develop, in your head, this sort of building of the day as it develops. Then, if the market responded in a way counter to the principle that I've taught you and that you understand, it's complete, it's such invaluable information. It's so important. I cannot stress enough when, for instance, a market, shows us something and we know that the outcome of that should be, X, Y, and Z. If it doesn't do that, it's telling us something so vital. And, even if you lose money in that situation, don't lose the lesson, or at least don't forget the information that the market is actually revealing to you. So, again, those control identifiers. Remember, we had strong ones and we had weak ones that we spoke about in part 7. They are nothing more than sentiment signals or confidence signals. They show us the level of confidence in how the market is actually facilitating trade. Now, first one, remember we spoke a little bit about tails. So remember, with regards to the tails, size and location is crucial. We have invisible tails as well as sort of open and extreme tails. Now, the important thing to understand is that the larger the tail, the larger the level of conviction or strength is at that given point. Equally, the larger the tail, the more significant the point is that, or the price is that we are rejecting or moving away from. as well as obviously where does that tail occur, alright? A tail in the middle of a trade location in a balanced area is far less significant than a tail formed when we are out of balance or in non-symmetrical type days. So very crucial to interpret where is where is the location of the tail, but also what is the size. Then in terms of value area overlap, how much overlap do we get between yesterday's value area, or where the market accepted price, and where the market is accepting price today? Again, markets that are overlapping a lot of value area will tend to continue to do that until we get some market moving information. Whereas if there's a lack of overlap in value areas, this could be sort of showing us high potential for one time framing on a day-to-day basis. So again, understanding how much overlap we get within the value area is crucial. We will talk a little bit more about this control identifier in Module 3. Then again, low volume areas and high volume areas, both crucial control identifiers. Low volume areas show us strength or stronger control variables, whereas high volume areas show us less strength. Time. Crucial. We spoke about this element earlier in Module 2. Just remember, less time, the less time a market takes, to effectively accept or reject something, it's showing us one thing versus if a market's taking more time. So again, time regulates the opportunity. Don't forget to always interpret your strategies in terms of time. Some strategies should take relatively little time to play out, and some strategies should take a long time. So again, if it comes counter to the principle, make sure you're interpreting this, because this can be an early identifier for a potential of the failure of the strategy and even potential for reversal of the strategy. And then lastly, or second to last, if a market spends a long time at an important juncture point, the longer time spent reflects an increasing probability of failure. Just like we said, time regulates the opportunity. So time is a great barometer for conviction and confidence. Again, take for example when we spoke about initiative. There should be relatively little time when a market initiates and accepts to initiating again. If a market initiates and then spends a long time balancing out, it's highly likely that we've seen the end of this initiation, at least for the given time frame. So again, time will regulate each one of the opportunities and strategies you develop. Now, to finish off and just to summarize, time provides the signal, and the structure that we've developed with the volume profile provides the confirmation. Now, as we continue the discussion on the control variables, it's important to understand what the various control variables might mean, whether they're strong or weak, but it's also crucial to understand where these control variables are occurring. So, important is control variables around reference points, and those reference points can be daily, weekly, monthly highs and lows. That can be key bracketed regions. That can be consolidated structural breaks. Now, it's important to understand, if we expect to see a lot of strength and potential for low volume areas when we break out of a consolidated area, we need to incorporate that into our strategy development. Whereas, for instance, if we want to develop sort of two-way trade type strategies, then we need to identify at which point would we likely see, or at which reference points would we likely see the various control variables. Now note, just to sort of again sort of as an example, remember when we see key breakouts, whether they trend continuation patterns or a break of a consolidation, or even just a breakout of the previous day's range, we need to see that initiative response, and that initiative response will imply new business as well as new positioning, and this is where the opportunity is, because we should, in theory, see continuation of trend. If we do not, we will get a very aggressive reversal. Why? Because there's positioning or new positioning in the market that thus needs to unwind. So that is why we pay close attention, to the various control variables around key reference points. Now note, as we've said there, failure to follow through is just as significant as no follow through. So don't always, if you're a momentum trader and you've got a lot of, momentum patterns, don't just always, analyze it from one side. Be flexible, be nimble, because some of the best reversals and best opportunities lie in the face of adversity or go against what everyone is doing. So make sure, when something doesn't work out, always look at it from the other side. Look at it. Is there an opportunity that I could have taken advantage of? Then. So some of our price expectations and hypothesis development. What do we mean by that? Well, the importance of pattern recognition is not in the act of labeling different market structures. Rather, it is essential for understanding current market activity, but most important, learning to visualize future market development. So all we're trying to say here is that, guys, it's not so important, recognizing the patterns and having all these trade setups and all these principles, but it's more important to just make sure you're always keeping up with the current market activity. Always trying to see what is the market doing now versus what it's telling me. What should the market have done versus what it was telling me. That's how you want to look at the markets, because when you start to look at the markets from this blank canvas, non-biased view where you're paying attention purely to the factual information, you're going to start learning to develop early pattern recognition, almost like filling in the puzzle before the market is able to do it. And if you're able to do that, you will become a highly effective volume profiling trader. Let's now turn our attention to three of the most or three very common profile or volume profile strategies we'll see for the rest of this module. Now we've completed talking about the control variables. Let's look at three very distinct profiling patterns you can expect to see when looking at the volume profiles. The first would be trending, the second would be short covering, and the third, long liquidation. We're now going to go through each one of these individually, look at the characteristics, and then turn to the chalkboard so I can show you how to develop your strategies based on these three unique, distinct profiling patterns. So the first of these three patterns would be the trending pattern. Now again, we have dealt quite extensively with trending markets, speaking about the characteristics, speaking about the understanding as to why it's important to very early pick up on when a market is trying to trend, and also the understanding of how a market trends with initiative and responsive type price behavior. So just some of those characteristics again. Note that a trending market is where we have initiative from one time frame only, and all time frames are in agreement of price direction. Note, we have a lack of pullbacks in a trending market and a lack of two-way trade. And we do have a very early identifier when it comes to trend days, and that is the previous day's extreme point. Now note, markets tend to leave single prints early in the session, showing early confidence from either sellers or buyers. Now remember, as we spoke about some of the characteristics of a trend day, we also spoke about some of the strong control variables. Now what you would typically see in a trend day is all of those strong control variables being exhibited. It's very rare to see weak control variables being exhibited, and if they are, they tend to be like almost free gold lying around, because those you can be particularly aggressive on, as there is a strong conviction for prices to either move up or down. Then the market pauses at extremes as it runs into responsive sellers at the high and buyers at the low. So note again, what we typically see in a trend day is aggressive initiation until we run into responsive other time frame players, and then the market has a bit of two-way trade before then resuming the initiative move higher or lower. Note, it is a high conviction day type with very early identifiers. Some of those identifiers can include tails, volume value areas that are got very little overlap, as well as low volume areas, single prints, and other strong control variables. So make sure you understand those strong control variables, as those will be quite evident early on within a trend day. Let's now turn our attention to the second of the profiling patterns. The second pattern we're going to take a look at is short covering, also known as the P-shaped profile. Now, note, very important is that when we get a P or short covering, it's due to an overextended sell-off and the market has accepted very little value on the way down. So the market's been failing to accept any kind of balance. Now, you would typically see, as we spoke about the different phases of a trending initiative move, this would occur toward the back end or the end of, the initial phase. Now, it's important to understand this as, this is the phase where probably the weakest shorts would enter the market, and that is why we tend to get this short liquidation type move. Now, note, participants get too short, too fast, we get very little balance, and due to that the market eventually bounces. It runs into very aggressive buyers that are waiting and responding to lower prices, and as a result of prices moving higher, those weak shorts that got in too aggressively unwind those positions, and that takes prices higher. Now note, prices will continue to move higher until such a point as we run into responsive, fresh sellers waiting for higher prices. Now note, there's a high probability that this low is revisited at some point in time. So when we see both short covering patterns as well as long liquidation patterns, that does not necessarily represent a top or a bottom or a big turning point in the market. It's merely the market taking a little bit of a breather, a little bit of profit taking, so that the market can just balance out a little bit. So crucial to understand when you see both the B shape and the P shape profile pattern. So note, as we said, we first want to see a little bit of acceptance and a little bit of balance, and the high probability trade setup in this case is once the market has, as prices moved higher and we finally run into responsive sellers that are looking to initiate fresh shorts, that is the point we want to look to initiate short trades with the short-term trend. But not to worry, we will talk a little bit more about this strategy on the blackboard in later slides. Our next pattern we're going to look at is the long liquidation profile. This pattern is almost the exact opposite of the P profile that we spoke about. Now, long liquidation or the B-shaped profile usually occurs when we get an overextended rally. So the market doesn't accept any value on the way high and we get very little balance. So the symmetry of the market becomes very non-symmetrical and unbalanced. As a result, what occurs is we get some very bad, or some very aggressive buying into very, very high and premium prices, and all of a sudden that initiates or that gets a response from longer term sellers. And what then occurs is we get an aggressive sell side response, and what makes the move very aggressive and the reversal very aggressive is that anyone who bought too aggressively and got long too high up will then liquidate those longs and be forced out of those long positions, resulting in quite an aggressive looking reversal type move. Now, important to note, the market will continue to filter lower until it runs into longer term responsive buyers. Now note again, as we said in the P shape, the B shape is highly likely that high gets revisited and retested at some point in the future. So again, the high probability trade is to wait for the market to sell off to such a point that responsive buyers are brought back into the game. We then look to buy with those responsive buyers for a move up toward higher prices. Now let's turn our attention to the chalkboard and look how we can develop some strategies using these three distinct profiling patterns. Welcome back, guys, to part 8 of the learning Blackboard Learning series. So where we got going in part 8 was we started again with the control variables and understanding what some of the early identifiers are where there is control being exhibited by either the buyers or the sellers. And we made mention back in part 7 about the stronger control variables and then the weaker control variables. And the important thing to understand, and again why we want to develop these control identifiers, is because we want to understand. So for us, we want to interpret and understand what is going to occur at, let's say, this being the previous high of the day or this being the previous low of the day. In other words, what type of control variables would we expect to see at these points? Now, let's take, for example, say now we had quite a significant high in place, and we got back to this high. What we want to see is either we're going to get strength in these control variables. So maybe we see some tails, maybe we see some low volume areas, and we see strength as we take out this key referencing point in the market. Now, that strength, or that identifier that's showing strength, whether it's a low volume area or maybe a hidden tail, that strength is guiding us to interpret and understand what the next, or what the likelihood is for a continuation of prices. And that would most likely be to the upside, given we've got strong control variables. Let's say, for example, on the flip side, we came up to this low point, and again, a significant low in the market. We came to this point, we bounced off, we came back, we retested, we bounced off, we came back, and we retested the third time, leaving what we could call a very bad low, and the market started to navigate away from it. Now, again, we want to interpret, what did we expect to see at that low versus what we actually saw at that low? Because now, if we have an expectation in place as to what we expect to see at various referencing points in the markets, we can then begin to develop hypotheses whereby we expect to see continuation. If we don't get these control variables, we don't initiate the strategies. Equally, to the downside, once we get this weak control variable, we can then look to initiate strategies which would look to eventually correct the bad low or the anomaly in the market. So that is what we spoke about when talking about control identifiers, but more important, using those control identifiers whilst developing strategies or hypotheses within the volume profile. We then moved on and we spoke about 3 unique patterns that you're going to see not just in this module but in the following modules, and we're going to talk quite extensively about them over time. And those 3 types of patterns were, firstly, trend, which can be illustrated with a lot of initiative and small distributions. We then had our P distribution, where the market shows initiative, the market shows initiative from sellers. It runs, so we see initiative selling. We run into very aggressive, responsive buying. The market then quickly forces out the short, so we get a bit of profit take until we find responsive sellers, and the market then distributes sideways. Our third pattern was with the B shape, which is the long liquidation. Again, buyers initiate until they run into responsive sellers. We then see sellers being forced out of this, we then see buyers being forced out of those positions until we run into responsive buying again, and then the market distributes and we form the B shape. Now, the important thing to understand with all 3 of these types of patterns is that we can develop unique strategies based on them. Now, I'm going to go through each one of these individually, and I'm going to show you where the key pinch points are within each one of these strategies. Now, we're going to start off with a trend because this is probably the easiest day type to trade. Now, what catches a lot of people out on this day type is that there's a tendency to, one, because we're so used to seeing the markets distributing and not trending and bracketing, there's a high tendency that we sometimes pick up on this trend a little bit too late. As a result of this, by the time the trend is well set and developed, if we cannot psychologically bring ourselves back to what we're seeing objectively in front of us, we tend to spend the day actually fading the trend for most of it. So again, it's not a flaw, it's just that a lot of the time, trend days, they're relatively rare. So when we do see them, we have a tendency to almost not believe in them. And that's why people who believe in the trend, who are ready for the trend, who early identify the trend and become aggressive, get very handsomely rewarded when there is trend in the market. Now, the key first identifier would be tails, whether that's at the top, whether that's at the bottom. That's the first thing we want to look for, is tails. Any kind of initiative from the open, whether that's an open drive or an open test drive. So first thing is, where do we open? All right. Second thing is, where are we balancing or are we unbalanced? Now, typically, you would find that markets tend to trend from a balanced distribution. So it's very unusual that we see a market trending, when it's completely out of balance. So it might be a within range, within value area where the market opens and then drives out and shows that initiative and trend very early on. Then the important thing to understand is the control variables. So we want to see control variables such as the low volume areas, the multiple distributions, the multiple small distributions. These control variables are showing us the control being exhibited by the buyers over the course of the day. Let's draw that again. Then the fact that the VPOC continually moves up the page. Again, another control variable. But all these variables are showing us strength within the market. Now, in terms of strategy, it is the most simplest trade strategy where you just want to, in this example, you just want to be a buyer all day long. Now, we can lean on a number of variables, starting with the initial balance, high or low. That can be an early identifier, but equally how we respond on the break of that initial high or low. Now, typically what you'll find is in a trend day, you will typically see when the market breaks the initial balance, high or low, if we call that the IB high and the IB low, typically, we would find the market very quickly auctions away from it, leaves a low volume area before continuing in that direction. So this is what we would typically see in a trend day type. So as you can see, with a trend day, there's a lot of characteristics that define the trend day. There's a lot of objective sort of pointers that the market shows us. Just a lot of the time, we almost psychologically get bluffed out of a trend day. The important thing to understand is you want to remain a buyer all day long. And when we do run into responsive sellers in this instance, it is okay to try shorts. But remember, in a trend day where there's initiative, the pain will be felt going against the trend. So, in this day type, if you're not going to go with the flow, rather don't go against it, because it can do a lot of damage to confidence, to P&L, to understanding and interpretation. So that's our first strategy play. Then our next one would be the P shape, or the the short profit-taking type move that the market exhibits. Now, it's very simple. The first thing to understand before we employ a strategy is what creates the pattern. Well, very simply, we start off, step one, we have initiative selling, so strong selling. It tends to occur at the end of a maturing trend, and we get that initiative and aggressive quite early in the day. So again, you will see strong control variables in this. You'll see wider TPOs, more volatile TPOs, expanded ranges within the auction process. It then runs into a key bottom where, again, we tend to see quite a good auction process. So it's unusual in this day type, a P or a B for that matter, to see a loss of momentum extreme. Remember, we spoke about the three types of extremes: one, loss of momentum, and then the two types of excess. More often than not, you're going to see a V type or an inverse V type reversal pattern. So you get that equal and opposite type reversal. The market then eventually runs into responsive sellers. So initially we had initiative sellers, and then we ran into responsive buying, and then we run into responsive selling. They're no longer initiative, they're merely just responding to higher prices. That response then forms the two-way trade and the distribution. Now, the strategy is very simple in this play. Firstly, when we see that exhaustive type a V reversal, okay, we want to be ensuring that we're not sitting there selling this on the way back up, because what we then do is we're almost putting ourselves in a position whereby we cannot take advantage when it finally runs into responsive sellers. So the first thing to understand is when we do get this, this little bit of a P shape or this profit taking from shorts, the bounce tends to be a lot deeper than normal. So traditional things like Fibonacci's or those sorts of tools can come in handy. But in terms of a profile, well, it's very typical that if this was the current day or the previous day's area, we broke lower before reversing, it's very typical that we're going to retest the previous day's accepted area. So you can use that, maybe the VPOC or the value area low of the previous day, or as a potential target for where we might then run into fresh responsive selling. So when you then find that responsive selling at a key point, that is where we want to enter fresh shorts. Why? Because, well, obviously these longs, all the longs now have gotten their move. They've squeezed out all the, the aggressive shorts, and the market will now begin to distribute. So that would be our first entry, looking for shorts, again, at a key reference point, whether that's the previous day's value area low or volume point of control. We then look to take that trade back down towards where we will then run into fresh responsive buyers. Now, again, sometimes this can go quite deep. What you need to keep in mind is that we want to find that point where the market runs out of selling, so we no longer see sellers responding and selling lower prices, but then we start to see buyers step in and accumulate. And it's at that point we want to look to cover our shorts and initiate fresh longs. Now, one of the hardest things to do when this trade develops is to keep trading it on both sides, because there's a natural bias to want to choose either long or short. So when you see this, the reward is doing the brave trade. The reward is doing the hard trade. And the hard trade is to be a seller at higher prices and a buyer at lower prices. So when you see this, be aggressive, do the job you need to do, and take advantage of this pattern play, because it's likely that you're going to get a lot of two-way trade being facilitated. What you don't want to do is start trading it a lot later on in the day once it's showing you that distribution, because then there's a lot of information in the market that will effectively mean the probability or the probability of succeeding with a strategy would have reduced. So that's the example of the P shape. Now, the B shape is exactly the opposite, and the trade strategy is exactly the opposite. What we're looking for is, again, once we find that a responsive selling point and we get the V, we want to initiate where? On our previous day's volume profile, maybe at the volume point of control or the value area high. Once we run into that responsive buying again, we want to look to buy with them until we run into responsive sellers, where we want to then cover and look to sell back down and play the distribution. So that's our basic example of a trend example, a P strategy, and a B strategy. Make sure you understand first and foremost what is creating these patterns, what creates trend, what creates long liquidation and short covering. When you understand the principle behind it, then develop the types of strategies that make sure you are trading with the market and in tune with the context of the market. Those are our 3 pattern plays for part 8 in our Blackboard learning series. Continue on now with part 8, and I'll see you again at the end of part 8. It's that time now where we can finally put everything we've learned so far in Module 1 and Module 2 into a very concise template that we can complete on a day-to-day basis and even on the weekend. So it's crucial that you not only sort of, have a look at the template that I'm going to show you and go through with you, step by step, but make sure that you utilize this template and complete it on a daily basis, because this will remind you of all the principles you've learned. It'll help you identify early observations and make much better trading decisions. So note, the template's broken up into 4 major sections. The first will be the value area placement, so where the value area is trading relative to the previous day and maybe the previous week. Then the template will talk about the attempted direction, so where we open, where we close, and where is value being accepted. So just giving us a little bit of a relative understanding about the attempted direction and who's in control. We'll then talk, or the template will then show us and talk about profile shape. Have we got symmetry or non-symmetry? Have we got balance or no balance? Are we trending or not trending? And are we, sort of showing bracketing or trending type markets? And then volume. Our template will show us a little bit about relative volume, relative ranges, and all sorts of, sort of relative statistics that we can utilize. So with these 4 major pillars, let's not go into the template. Let's get up a basic example. Let's complete this template together so you can get a better understanding of what we've dealt with so far in in Module 1 and Module 2. Welcome to the final stages of Module 2, Part 8. We're going to talk a little bit about deliberate practice. Now, as you can see the little golf man there, I absolutely love golf, and the reason is that golf has got so many similarities to that of a trader. And one of the key, sort of things that, if anyone knows a golfer, is how hard and deliberately they practice their game. I mean, these guys can spend, hours standing over a 3-foot putt, and they can hit the same putt 100 times over. All just for muscle memory, all for sort of repetition to build confidence, to build trust in what they're trying to do. And I find too many traders, they have brilliant minds and brilliant understanding, but they just don't practice enough. Whether it's practicing their skill set, whether it's practicing the strategies that they develop, they just don't practice enough. So what we're going to talk about is deliberate practice and why it's so crucial to the success of becoming a trader. Now, so why do we have an exact process to view the markets? Why do we want to every day view the markets through the same lens? Well, it's very simple. Firstly, it allows us to benchmark. So we can, by looking at the market through the same template every day, we're going to learn to almost, identify and pick up on certain changes and pick up when we're deviating from the plan and when we're not sticking to the plan. Next, pattern recognition. So again, if we use the same template every day, we're going to start picking up and identifying various patterns that play out in the market, and what patterns are working and what patterns are not working. And again, routine, discipline, and precision, guys. If we deliberately practice every day, or have a template every day, or arrive at the same time every day, we're developing routine, we're developing discipline, and we're developing precision. And these are all key elements to not just developing edge, not just developing or becoming a successful trader, but to becoming successful at any endeavor, whether it's golf or trading. So what are some of the deliberate practice methods you could utilize? Well, firstly, playback functionality. I will show you a little bit more about this playback functionality, in Module 3. But what we're basically going to do there is we're going to play back how a volume profile develops over time. And what you'll learn to do with this is you'll learn to not just pick up on key early observations, but you'll then learn to trade and exit and enter as a day that is developing, whilst not risking any capital. And again, this is going to install confidence and trust in some of the patterns that I'm developing with you, as well as some of the strategies you will develop over time. Then looking at patterns in isolation, also known as backtesting. So it's crucial that, when you do identify one pattern, don't just, keep that one pattern. Go find as many observations of that pattern as possible. Break it down into its basic elements and learn all about, the different variations of how that pattern could potentially play out. And then we want to put the patterns across various trade locations. So again, we test these patterns, we deliberately put them in different situations so as to see how they respond in different conditions, different trade locations, different contexts. Doing this again will help us to master the pattern in various conditions so that when times become a little bit tougher and a little bit different, it's not new to us, but it's merely something we've seen before. And then lastly, backtesting over time within various conditions, as we've mentioned before. So to summarize and to finish off, with Module 2 and Part 8, volume profiling is a tool that organizes information in a manner that allows for easy identification of cumbersome information. Good luck, and make sure you get that concept checker and playbook completed. Hey guys, and welcome to the Blackboard Learning Series again for the final part of Module 2. We're going to do something very exciting now. We're going to actually take you through a typical volume profile template example. I'm going to show you what I as a trader would do on a day-to-day basis to ensure that I'm not missing any elements or objective facts that are coming via the volume profiling tool. Then we're going to talk, in fact, what we're going to do is we're going to first talk about deliberate practice and we'll come back to the template example. So just with regards to deliberate practice, it's crucial that you understand that trading is like any skill. It takes time to develop your skill set. It takes time to develop your patterns, and it'll take time to develop consistency in the marketplace. So the important thing is that you put in place deliberate practice measures. Now, the reason we have, we want to deliberately practice things is because, one, when we're deliberately practicing something, it's helping us develop routine. It's helping us develop discipline, it's helping us develop patience, and it's helping us develop trust in what we are doing and trying to achieve. Now, there's various ways you can exhibit deliberate practice. Just like a sportsman or a footballer will kick a corner kick 20, 30, 40 times in one session, we need to watch various strategies time and time again. And we need to see these patterns in various markets, in various trade locations, in various contexts. When we do this, when we identify the same pattern across multiple different asset classes and locations, we are going to become masters of that strategy. And that is why we want to do this exact practice. More importantly, we can also do playback functionality. Playback functionality allows us to look at how a day type played out. So what we can do is look at a day type in the beginning, we can then have our hypothesis in place, and then fast forward the day over a period of, say, a half an hour or hour, and try and trade the day as it is occurring. Try and put ourselves in the position as though we were allocating real capital. And then last but not least, backtesting. Right? Backtesting is a great form of deliberate practice where we're constantly looking at our strategies, constantly developing and evolving them as the conditions vary and adjust in the marketplace. So that's what we spoke about with regards to the deliberate practice. Now let's turn our attention to something a little more exciting, and let's bring up our example of a template. So as you can see in front of you, we have a traditional daily trading sheet. Now, what I'm going to go through is just the basics of what a daily trading sheet would look like, but then I'm going to spend some time on the basic premise of a template, of how to take everything we've learned so far in Module 1, in Module 2, and almost summarize it in a very short space. And by summarizing it like that, we can almost take all the information, put it into a few little lines, and come out with a very good understanding as well as hypothesis and strategies we can employ. So a typical trading sheet will always start with our week's goals. Now, I see so many traders that don't have goals in mind. You have to have goals, and those goals can be short-term, they can be long-term. It doesn't really matter. What is important is that you do have some goals in mind. Then what we'll then typically look at is the calendar. What is likely to occur over the period of the session. Again, the calendar or key data will bring volatility and will bring range expansion into the market. We then start off typically our day by registering where the closes and the opening calls might be. Now, again, this might differ for various traders, but important, if you're trading the European session, you need to know what happened in the overnight session. If you're trading the US session, you need to know how the European session is traded, and then base your opening and closing calls based on that. We then want to look at some of the key, in this example, some of the key overnight indicators being maybe the Asian equity indices, maybe the yen, given it's a highly traded currency, but it's also a good correlation currency with risk on and risk off, as well as the gold, the dollar, and the VIX. Again, this is not necessarily the indications or the indicators you need to look at, but you need to look at indications that bring you up to speed with what the market has done whilst you've been away. So that's the first part that we would typically do pre-open, of the market. Then we would move on to utilizing or creating our template using volume profiling. So as you can see, we would start off by identifying the previous or the potential for day type. So straight away, this would be done somewhere between the first hour of trade. We would try and identify, what kind of day type did we exhibit on the previous day. Was normal distribution, non-trend, neutral day, normal variation, trend day, double distribution. So straight away, we look at the previous day and we try and create for ourselves a little bit of understanding as to what we could potentially expect today. We then look at the open. So we look at the first hour of trade. How does the market open today based on what we had yesterday? Is it a strong convicted open with an open drive, or is it more an open auction? We then look at what kind of a nature is the market in, what type of context is the market currently bracketing. Are we seeing a lot of overlapping type profiles, or are we seeing trending profiles where we have very little overlap? We would then look at our value area location. So over the past couple of days, or over yesterday to today, where are we opening and where are we trading relative to the previous day's range and value area? And then how much value area overlap? Again, we'll talk a little bit more about this in Module 3. And then we're going to talk about some of the key identifiers, the control identifiers like low volume areas or high volume areas, excess points in the previous days like tails, gaps, open, close gaps, volume point of control, what location is, what shape is it? Is it protruding? Are there a number of prices that could have been the volume point of control? And then any of the anomalies we could have seen over the previous day. We'll then talk about initiative buying and selling. So we'll look at the previous day's auctions, we'll look how the market auctioned, and look where the initiative came in, where the responsive came in. Try and get an understanding of where the interaction points were coming between buyers and sellers. And lastly, we'll look for our key reference points in the market. Now, these reference points can be a high and a low, they can be major support and resistance, they can be major trend line breaks, they could be any number of factors. The important thing is we want to identify what are those key reference points. What is our expectation in terms of control identifiers around those key reference points? Once we have completed all of this analysis, this understanding, we then have a process whereby we can develop our strategy for the day. Now, again, you can do this, as you can see in this example of a trade sheet. You can see this is done predominantly for German bunds and European stocks. This can be done across any multitude of markets, whether it's oil, gold, Euro stocks, E-mini S&Ps, it does not matter. The important thing to understand here is the process is the same regardless. So that's what I wanted to identify and show you on this trading sheet. Lastly, on a typical trading sheet, you would also have your charting routine. So again, just keeping you within a process. Where are the key weekly markers? Where are your key volume lines? So in other words, to be able to have relative volume, we need to know what is relatively high, what is relatively low. Where are the key levels? What is the volume price analysis, our profile analysis, our delta accumulation analysis, our anomalies, and our basic initiative and responsive buying. So again, just bringing ourselves into an objective process understanding of what the market is telling us. And I like that quote there at the bottom. That quote almost summarizes the whole point of me showing you this template, okay? Failing to plan is planning to fail. If you're not willing to plan properly, you're going to fail. You are behind everyone who has planned better than you. That is why we plan, because then we are prepared and we trust in what we are trying to do and achieve. And then just a few other things you would typically find, sometimes if you're battling with something, for instance, if you're battling with patience, sometimes it's wonderful to go and write down, what it is you understand about patience. Okay? When you start to write your thoughts down and your beliefs and your understandings, then you're going to open your mind up to development. You're going to open your mind up to almost that thing you're struggling with will almost become your strength. And that is why we start to break down, maybe the key troubles into these basic elements of understanding. Don't forget, guys, as human beings, we have a natural tendency to fear things we don't understand. So by writing them down, by writing down what it means to you, you will develop understanding. And then some other things you would typically find are maybe 3-tier longer-term goals, or maybe a routine. What is your key routine to success? What type of routine do you need to show to effectively be successful in your endeavor? And then obviously your rules of trading. What are your key identifiable rules of trading that you need to ensure you're constantly doing in order to achieve success? So that's where we're going to finish this, guys. I cannot stress enough to you how important it is to understand that having a structure in place, like a template, like a 2-page thing you need to complete every day, that is going to, not only is that deliberate practice, but that is going to help you to see the market through the same hourglass every single morning. And if you do that, you are going to be able to develop some extremely good habits, some extremely good processes, but ultimately some extremely good winning characteristics and strategies. So that's the end of part 8 now, and I hope you've enjoyed part 8. It's been a very good part where we've sort of started with principles and we then started to slowly develop, key trading strategies on that principles. Get excited, guys. We're about to start Module 3. Module 3 is very practical, lots of examples, a lot of playback functionality. We are going to break down these strategies, looking at execution, entries, exits, and a whole lot more. Good luck, and I look forward to seeing you guys in Module 3. Congratulations, you've reached the end of Module 2, Part 8. Let's check over those principles one last time. So, what are the 3 distinct patterns found in volume profiling that we discussed in Part 8? Then, what are the methods of deliberate practice, and why are they so important? Good luck. This is the final opportunity to insert what we've learned in Module 2 Part 8 into our playbook. So answer the following 2 questions. Firstly, find the distinct patterns, being trend, P-shape and B-shape, in the German Bund, S&P 500 Index, WTI oil and the Eurodollar FX, and insert them into the space provided. Again, take your time in finding these patterns, spend a little bit of time interpreting and understanding their location and why and how they are occurring. Then, complete the volume profile template as we did in the example I did with you, and put this into your playbook with the example that I've provided you with. Good luck, congratulations, and we'll see you in Module 3.
What do you think of Malcolm Gladwell's theory that the years 1953 to 1955 were the perfect ones in which to be born for the computer revolution?
Well, his book makes a lot of great points. That is that in all success stories, there are significant elements of luck and timing. I wasn't the only kid born between 1953 and 55, but absolutely to be young and open-minded at a time when the microprocessor was invented. In my case, I have a friend, Paul Allen, who was more open-minded about hardware-type things, and literally brought me the obscure article that talked about that first microprocessor and said, this is going to improve exponentially. What does that mean? And I said, well, that means we can do anything we want. And then he was, bugging me the rest of the time. Every time there'd be a new microprocessor, he said, can we do something yet? And when we were in high school, that didn't happen. So he came back to Boston, took a job there, and actually the microprocessor that was finally good enough came out in early 1975, and that's why I dropped out. So the timing was pretty important. Why didn't older people see it? Well, they weren't as open-minded. They didn't think about software as the key ingredient. Now, a lot of kids started doing software, and it's not, if somebody reads the book to say that if you spend 10,000 hours doing something, you'll be super good at it, I don't think that's quite as simple as that. What you do is you do about 50 hours, and 90% drop out because they don't like it or they're not good. You do another 50 hours, and 90% drop out. So there's these constant cycles, and you do have to be lucky enough, but also fanatical enough to keep going. And so the person who makes it to 10,000 hours is not just somebody who's done it for 10,000 hours. There's somebody who's chosen and been chosen in many different times. And so all these magical things came together, including who I know in that time. And I think that's very important. When you look at somebody who's good and say, could I do it like them? They've gone through so many cycles that it may fool you that, yes, you could with the right luck, imagination, and some talent.